All right, hey, welcome to chapter 3. Let me share my screen so you can see it too. All right. So obviously I'm a little different than my other videos because I found out that my chapter 3 video is giving us problems, and therefore I wanted to make sure I re-recorded this. So look a little different, sound a little different, whatever. It's all good. Still me, still me. Hope you guys are having a great day. Chapter 3 are adjusting accounts for financial statements. Basically, what we're doing is we're making adjusting journal entries to account for the things that we don't normally have a transaction to trigger. All right, so let's go ahead and just dive on in. You can look at the learning objectives as you want. So, considering our time period assumption, we can break out our accounting periods into meaningful times. Typically, it's going to be monthly, quarterly, or annually. All right, semi-annually, they throw in there. I mean, accounting periods for some companies are actually 18 months, so you can throw that kind of stuff in there if you want. But during these times, we create what are called intern financial statements. And these financial statements are ones we report, even though they're not audited necessarily. The annual one is. Um, it does give our creditors and our investors a little bit of idea of where we're at currently in the scope of things. And of course, if we do anything that's misleading, that's not a good thing. So, oh, I clicked on the camera thing to move it out there. Now, the biggest thing that we want to come out of this is the accrual basis is different than the cash basis that we're dealing with in accounting. Accrual basis is what I've been teaching you in class, and what we've been talking about more than likely is that, or that your professor has been. Revenues are recorded when we actually do the service or provide the goods. It's not when we get cash. Cash is, it's not irrelevant. Cash is a very necessary thing in accounting, but the accrual basis is we focus on when we do the work, when it's accomplished. On the other side of it, when expenses occur, when we use the expense, not necessarily when we pay it off, is when we're going to recognize these revenues and expenses. The cash basis is what you're probably used to. You're used to when you get money, you record a revenue. When you spend money, you record an expense. Well, that's not how it is in accounting. We do it when we use it or when we earn it. So with the accrual basis versus the cash basis, is going to go through an example. On the accrual basis, let's say $100 of insurance expenses. I'm sorry, I'm not going to read this because you can read this. What we're looking at here is 3 years for 2 years worth of insurance expense. We pay for it on December, 1st, and so we use 1 month's worth of uh, insurance expense in 2021. 2022, we got 12 months, and in 2023, we have 11 months. We expense it as we use it. But if this were the cash basis of accounting, we would spend an expense to $2,400 in December. That's it. It'd be over. But you can see we're using this expense throughout another almost 2 years. And so it doesn't make sense to expense it all today when we're going to be using it, and we haven't used it all the way until 2023, according to this example. So that's kind of the difference between cash basis and the accrual basis. We're going to look at it in a little more depth here. The cash basis here, you can see that's all expensed in December of 2021, and nothing is expensed in the later years. But this violates our matching principle. We have to expense it in the years we use it, not when we pay for it. So cash basis can be hard to get that out of our head. Okay, it really is, because we're whole lives are dealing with the cash basis, but we do the accrual basis of accounting. Now, like I said before, recognizing revenues is when we earn it, or when we provide the goods or services or whatever it is that we are going to get paid for. Because see, we can actually get money back, or I'm sorry, get money back, get us money today for work we haven't done. That's not revenue. We haven't done the work. And so it can go both ways if you're working in the cash basis where, oh, you got money and you didn't want it because you were trying to, not pay taxes, but someone else paid you. Now you have to recognize it. In accrual basis, it's only when you've earned it do you recognize it. Same thing with the expense recognition or matching principle. You're not going to expense it unless you've used it. You can spend all the money you want, but if you haven't used whatever it is you paid that money for, you don't get to expense it yet. Let's take supplies, for example, and I think we have some later examples of this. If you buy a bunch of copy paper at the end of the year, well, you don't get to expense it because you didn't use it. You just have a whole bunch. You turned one asset of cash into another asset of supplies. And it's not until you use it that you get to expense it. So here we are. looking at the framework for adjustment slide here. And this is funny. If you're in my in-person class, sometimes I really I mess this up because I deal a lot of with accrual and stuff, and I forget the word deferral for some reason. So I'm actually glad I'm doing this again. I don't know why I always forget the word deferral. Deferral of expenses versus the accrued expenses, and deferral revenue versus accrued revenue. We're going to be discussing the various concepts here in these later slides, so I'm not going to get confusing for you right now. But look here, this is a 3-step process. This works for some, it doesn't work for all of them. This is kind of an area the book's kind of a little wonky on, but it says you should determine for step 1 what the current account balance equals. And then you look at it and see what it should equal, and then you just make the adjustment. That works for supplies. It doesn't exactly work for depreciation or some of these other ones. And I'm going to kind of go through that and show you here. So let's talk about the deferral of expenses. All right. So deferral of expenses mean we have paid for it today, but we're going to defer it to later because we haven't used it yet. So what we're going to do is we are going to credit our one asset account and prepaid deferral expenses. I started looking at the T-charts and it kind of threw me off. This one's, you know what? Let's not even worry about those T accounts because it's kind of blowing my mind. I don't know why. Oh, I get what it's saying now. All right. Sorry. The T accounts kind of, they're great accounts. Don't get me wrong. But I was sitting here talking about deferred expenses and it's showing me the adjusting entry to record as we use them. So that's what was throwing me off. Anyway, when you prepay an account, all right, let's say it was the example we had as prepaid insurance. You put that as one asset from cash into your prepaid account. So you go from one asset to another. Then as you use that new asset that's no longer cash, as you use it, you'll expense it. That's what the T accounts are trying to show here. I apologize. So you have one asset, which is your prepaid asset. As you use it, then you'll expense it. Let's just get to an example. So this is determining the current balance, all right? Fast Forward paid $2,400 to cover the insurance for 24 months, and we paid for it on December 1st. Now, their steps are going to say, what is the current balance? Well, it's $2,400 in the prepaid insurance account right there. Debit balance, asset account. Then it says that we want to find out what it should equal. Well, for me, it's a little easier to count. Okay, well, it's for 2 years. Take 24, divide it by 2, or excuse me, 24. That's $100 for each month. So I don't care what it should be. I used 1 month. It's $100. I'm going to adjust this for $100. That makes sense to me. But the book says to balance, the balance of the prepaid insurance should equal $2,300. Well, I don't disagree. All right. So we're going to expense these as $100. But see, that's funny because that's supposed to be step 3 that they're demonstrating. Again, not too big on this. So the ending balance on the prepaid insurance is going to be $2,300, and your insurance expense is going to have that $100 in there. Now, this is one thing I want to point out, and I'm not going to point it out on every slide. Okay, you have every adjusting journal entry is going to have one balance sheet account and one income statement account. It's going to be an asset tied with an expense, a liability tied with a revenue, or something like that. But it'll always be an asset or liability with a revenue or an expense every single time. And please, please, please note, you never adjust cash. All right, you never adjust it. The amount that you have in cash on your unadjusted trial balance is your balance going forward all the way till the end. Never gets changed unless you're doing something unlawful, at which point then don't do that. Okay, so here's your general journal entry. You're going to debit prepaid expense and credit your prepaid insurance. This is kind of another thing that the book kind of really throws you off. The T accounts are supposed to represent ledgers. We write them in the general journal, then post them to the ledger, and it kind of goes backward with these explanations, but that's all right. Okay, let's talk about supplies. This was the example I gave you where doing step 1 and then identifying the total balance. This one, steps 1 and 2 work on this. So you purchased $9,720 worth of supplies over the course of the month, in this case, December. Then you're going to send someone to go around and count up however much supplies you have left. And that person comes and says, well, you have $8,670 left. Then okay, well, I had $9,720. I now have $8,670. So now I need to know or I know that it requires a $1,050 adjustment to get from the supplies account of $9,720 to an $8,670. And then you are going to expense that account using a debit. So debit supplies expense, credit supplies. Again, your balance sheet and income statement accounts. Your general journal will see the supplies expense of $1,050 debited and credit supplies for $1,050 also. Our how many times did I say R? Sounds like a dog. Anyway, I have two, by the way. Supplies expense. Actually, I forgot what I was going to say, so forget it. Depreciation is our last prepaid that we're going to talk about, or our deferred expenses. What we have here is we bought a plant asset, okay? We bought some kind of thing that's going to last us longer. Well, we can't expense that whole thing in one accounting period when we paid for it. We've got to spread it out over the life of the asset. And as long as you don't drive crazy, that car should last you longer than a year. So we have to take however much we expect to use that car for, or vehicle, or equipment, building, whatever, and we're going to say, we think it'll last us this long, so we're going to spread those expenses out over that period of time. That's how it is. Now, this is giving you the formula for a straight line depreciation. For my classes, and I don't, if some of my adjuncts or other professors are using this video, they may say and have you do something different, but I don't make you learn the straight line method right now. We're going to learn about that in Accounting 112. But this is the information, so I'm going to just kind of skip past it. In every problem that I give you, it's going to tell you depreciation expense is this, okay? And so you don't need to worry about calculating it, so don't worry about it. If, again, your professor wants you to do it, then that's fine, but, you know, not in mine. All you're going to do is say, hey, $300 of depreciation for this account. You're going to debit depreciation expense, and you're going to credit accumulated depreciation. That accumulated depreciation is going to be something we collect so that we can show how much of our equipment or whatever our asset was that we're depreciating over the life, so we can make sure we show how much we've depreciated, how much is left. It's showing that we're expensing this over the life of that asset. Debit depreciation expense, credit accumulated depreciation for the equipment, both $300. And now let's look at it from the balance sheet perspective. You can either show that you have an equipment valued at $26,000 and that you have accumulated depreciation currently at whatever it is, in this case it's $900, and that you have what's called a book value at $25,100. Now you can do it the way I just described, or you can just simply say, I have equipment and its net balance or book value balance is $25,100. Either way is fine. This graphic is kind of small, so if you're watching this on your phone, I apologize. I'm afraid to try to zoom in because if it screws up my video, I have to start over, and I don't want to do that. Oh, and this just shows you exactly what I described. Okay, now we're going to defer revenues, okay? We are getting money that we have not earned yet, okay? We have unearned revenue is what we're going to talk about here. So unearned revenue is anything we've received in cash, or it could be other, you know, I don't deal in chickens or cows, but maybe some people do. I don't know. You've received something, but you haven't done what you need to do so that you can say you own it. Okay, we're dealing in cash in this world, but that's the idea is you've received something but haven't done what you need to do to show it. Here we are. So we have what do we got here? One of our clients, we're the company, paid us a 60-day fee in advance covering December 27th through February 24th. All right. This is going to get kind of convoluted with the percentages and how many days over the number of years. It's kind of a messy reference. I apologize, but let's look at this. First, we received the cash on December 26th. Debit cash $3,000, credit unearned consulting revenue for $3,000. Then as we earn it, we've done December 26, 27. Oh, I'm sorry. No, it is from 27, 27, 28, 29, 33. We've done 5 days of work that we've offered this consulting revenue for. So we take 3,000, we're going to divide this by the total number of days, which is 60, and then multiply it by 5, or take 5/60th times 3,000. However it makes sense to you and however it works for you, you decide, enjoy. Either way, you're going to get $250. So we know we need to adjust our liability account of unearned consulting revenue We are going to debit that $250 and we're going to show a revenue of $250. Now, don't get hung up on this $5,800 showing in the consulting revenue. That's just saying that hopefully we've earned more money other than just this $250. Because if all you ever earned in December was $250, you might be in a little trouble with your company. So that's not a problem. But our liability account unearned consulting revenue showed $3,000 because that's what they gave us on December 26th. But now we've earned $5 worth. Now, if for some reason that contract were cut or terminated, we would have to pay back $2,750 because we've earned 5 days worth. Now, in this case, that's where we're at. That's your balance sheet. That's your income statement. And we shows that during the month of December, we earned $6,050. I'd rather earn $6,050 than $250 person. Here's our general journal entry. We are going to debit unearned consulting revenue for $250 and credit consulting revenue. Normally, I usually in class, I'd stop now. Any questions? What are we understanding about this? Trying to get a feel for making sure everybody understands. But you can pause this. You can fast forward, rewind. You can put on ×2 or put on halftime so that I'll talk like this, whatever. But the point is, you can adjust this for however works for you. So now we're going to talk about accrued expenses. These are expenses that we have incurred but have yet to record, all right, or pay. And we're going to record them now, but we haven't paid them yet. So we're going to debit our expense because we've already used those things, and we're going to credit our liability. A great example of this is salaries. When we're working our employees, the employees will work a certain period of time, and then there'll be a cutoff day, an end of the month, an end of the quarter, end of the year. We got to write our financial statements as of that day. We owe them that money, and then the next, the rest of the time we'll continue on, but we got to tell our investors, hey, as of this day, we did owe these guys about $300 or however much. Let's go ahead and see the example. Fast Forward pays its employees $70 per day or $350 for a 5-day work week. Salaries are paid every 2 weeks on Friday. Pretty normal, right? So let's say there's one employee, I guess, because we're going to take $70 so December 31st is a Wednesday. So we have Monday, Tuesday, Wednesday, assuming it's 5-day work week. So we're assuming Monday through Friday. So Monday, Tuesday, Wednesday, they all worked. This one employee works Monday, Tuesday, Wednesday. So it's $70 per day. We're going to multiply that by 3. If that employee decided to quit, and it says 12/31, let's say January 1st, they were supposed to come in and work. And they're like, man, this is New Year's Day. I want to have my vacation. I quit. Hey, they're not going to get their full salary after the 5-day work week, right? They're just going to get for 3 days, but they're going to get that 3 days. So we have to say, hey, we owe us to them. If they decide to quit tomorrow, we don't know. We hope not, but we owe them this 3 days. So we got to say on our liabilities, our salaries payable, we're going to put $210 and we're going to expense it. We're going to do debit to salaries expense for $210, credit to salaries payable. And here's your journal as promised. General journal entry right there. Here is our T accounts, our ledger representation. We owe our employees $210. We're showing that for the rest of the month of December, we had $210 additional dollars that we owed our employees for a total of $1,610 for salaries expense for the month of December. That's pretty cheap. That's pretty cheap. I mean, they're saying $70 a day. If I divided that by 8 hours, that's like less than $10 an hour. This isn't in Arizona, that's for sure. And I don't know why it just popped into my head, but my other video, I guess, froze. So you couldn't see his picture. I sure hope this doesn't freeze again, but anyway. So as we incurred this expense, some of my students are like, but wait, I earned this money after that. Yes. What's going to happen is on January 9th, we've accrued 3 days worth of expenses, and we told our our creditors and our investors, we owed $210 as a credit to salaries payable. Now, when we go to pay them, we're going to debit that salaries payable to show we owe 0 now, expense the other 7 days that we were going to pay for the 2-week work period, and then pay that employee the $700. And I can multiply these numbers. You can say there's 50 employees at $70 a day. You just do all the math. But the point is, this is what we're focusing on is understanding, I'm going back in the slides, so don't think you're losing your marbles. Our sole purpose in this exercise is to identify how much money we owe to our employees at the close of the business on the last day of the accounting period. We got to tell our investors this information. We got to tell our creditors this information. Life's going to continue on. They're going to work the rest of those weeks or days, and we're going to pay them. But we got to, as of that day, we got to tell our important people what's going on there. Okay, then the last one we're going to talk about is preparing adjusting entries for accrued revenues. Okay, these are revenues that we have now earned, but we still haven't gotten paid for. And if you haven't noticed, let me go back again. I'm going back. Notice we've dealt with all these adjusting entries. We've said, you know, if it was salaries payable, salaries expense. I'm going back again. If we're going to go consulting revenue, unearned consulting revenue, they've always matched, right? There's a key there, but there is. Now I'm going forward. Sorry to make this. I hope you guys aren't getting sick. Oh, Brian, you're going so fast now. No, this is the one area where it doesn't match. Okay, this is the only area it doesn't match. When we do work and they're going to pay us later for it, we need to recognize that we've done the work, we've earned the revenue, but we're owed the money. So we're going to debit accounts receivable and credit the revenue that it's associated with. One area that it doesn't say, like, you know, the words are the same, but the concepts are still there. In this situation, our customer agreed to pay us $2,700 on January 10th for future services over the next 30 days. This occurred on December 12th. Well, 20 days worth of services occurred from December 12th to December 31st. So we take the $2,700 that they owe us, and we're going to multiply it by the 20 over 30 or 2/3 of it. And we're going to take that money and we're going to recognize that as revenue, in this case, $1,800. And so we make our adjustment, debit accounts receivable for $1,800, credit consulting revenue, in this case, for $1,800. I always use in my class example of tax, right? If I'm going to do someone's taxes, they give me money. Well, it's a liability. I'm sorry, no, I was doing it the other way around. Sorry. It's like you pay somebody to do your taxes for them, and until they actually do it, they owe you the money. I'm sorry, I'm really screwing this up. I do the taxes, and I haven't gotten paid yet. That's what I'm trying to say. I'm sorry. I got the money. I have not gotten the money. I've done the work. They owe me the money. Accounts receivable. Okay, that's where I shouldn't have even gone into that, just because I had already explained it, but I'm sorry. Okay, so here we go. Balance sheet, accounts receivable. It's an asset. Consulting revenue, income statement. It's a revenue. Our balance in accounts receivable shows we are owed $1,800. We bill our consultant, and we show that we got more revenue. Then later on, we get the money, right? They debit cash. On January 10th is when they said they were going to give us the money. We're going to recognize 10 days worth of revenue in the new accounting period. And then we are going to, we're debiting the full amount, but then we're crediting that accounts receivable so that it no longer shows that they owe us the money, because they gave us the money. So they don't owe us. We got to get rid of that receivable. All right. This is a really good slide that if you need to pause right now and kind of get a feel for what we just went through, this is very important. These are the concepts that we've really gone through. And I think it's a good slide for you to kind of understand how this works. Okay. So if you need to take some time on that last slide, very important. I highly recommend it. This last section, we're going to talk about preparing the financial statements from an adjusted trial balance. Now, this is it's called a worksheet, all right? And it looks like it's in Excel. It's in some form of spreadsheet anyway. The yellowy ones, and if for some reason for American Disability Act, it's the 4 columns to the left, all right? Where it's showing the account title and the number, then the first debits and credits. That's what we derived after doing all of our regular journal entries, okay? We get all that information. We say this is what it is. Then in the next 2 columns under adjustments, it's showing all of the adjustments we made. Now, these are all of the exact same ones we did for fast forward throughout these adjustments, okay? If you went back through the slides, you'd see every single one of these things are ones we identified and went through. And then the adjusted trial balance is what we're going to do from the unadjusted trial balance. We're either adding or subtract. Well, in this case, all adding. we're adding to those and showing the new balance in the adjusted trial balance. Okay. Now, here are steps for preparing the financial statements. You always do the income statement first. Always do that. I hope if you're in my class and I ask you what's the first financial statement you make, I hope you all enthusiastically yell income statement. If you do, I would be so happy, because most of the time everyone looks at me funny. But income statements first. Then we do the statement of owner's equity. Then the balance sheet. And then later in the book, actually later in Accounting 112, I'll show you how to do the statement of cash flows. Just know that that one exists. We only do steps 1 through 3 in Accounting 111. This is a chart showing you how it works. Now, I don't know if you can see my mouse, but if you look in the upper right corner where it says adjusted trial balance, you'll notice all of the trial balances are structured the exact same way. You see that where it says 403 consulting revenue, that's the start of your revenues. Everything from that first 400 level, or just the first revenue level listed there, everything below that is your balance or your income statement. Revenues and expenses. List the revenues, which are both credits first, then all the debits for the expenses, and that's going to give you your net income. That's your income statement to the left and down of where we were just looking. Then you're going to have Taylor, in this case, Taylor capital, Taylor withdrawals. That's going to be what you use for the statement of owner's equity, in addition to the net income you just calculated from the income statement. Then you're going to take the ending balance on the statement of owner's equity. You're going to put that in the equity section of the balance sheet. And from cash 101 all the way down to unearned consulting revenue 236 is going to be your liability, assets and liabilities. And you just put the balance and whatever it says there on the balance sheet. That's how you create the financial statements. Too easy. Now, I'm not going to have you guys analyze or compute profit margin, although you should kind of have a good idea on it. I mean, not a good idea. Just know that it exists. Take your net income divided by your net sales. Or in the case of a service company, you're going to take your net income divided by your revenue, whatever your revenue is. Okay. Net sales, don't worry. We'll get that in chapter 5. Don't worry about it right now. Don't worry about explaining alternatives in accounting for prepaids. I hate this method. I don't understand why anybody would use it. It's more work for the accountant, but for some reason, companies love to do this. It's ridiculous, but don't worry about it. I'm not even going to go over it, and I hope my adjuncts aren't going over it either. That is the end of chapter 3. Now, I should have said your word before, so maybe I'll go back here and pretend like I'm talking more before that. Your word is download. D-O... Hey, I never said I was a good speller. Download. D-O-W-N-L-O-A-D. Download. Delta Oscar Whiskey November Lima Oscar Alpha Delta. Okay, for those of you that like the phonetic alphabet. Download. Put that in the quiz. Spell it just as I said. Whether you put a space between it or not, it doesn't matter. Download your word, put it in there. I wish you the very best in this chapter. If you have any questions, please seek your professor out. It is important that you understand these concepts. Chapters 1 through 4 are critical, all right? And this chapter 3 is probably the peak of criticalness of those chapters, all right? Have a good one. Good luck, and we will see you in the next chapters.